But the economy has continued to slow in May after a generally pretty awful April, and it looks like they want to stimulate a bit more demand. So it's a very positive signal from China, and I think it significantly raises the chances that we'll see more rate cuts in the third quarter.
Stephen, does this move signal that China's more worried about its own domestic economy or the rest of the world, the slowdown that we're seeing elsewhere?
Well, I mean, certainly exports aren't doing too well. We're at 4%. We've still got growth. It's nothing like as bad as in 2008. Exports are still up for the year. But the primary concern is domestic. We're seeing domestic electricity production basically flat year on year. China's economy is 55% industry, and if industry isn't using electricity, then it's not growing. So this is primarily, I think, a domestic-driven move.
Stephen, this rate cut and your reference to the possibility of more rate cuts in the next couple of months, what does this mean for economic growth? Are you revising your GDP forecasts?
No, I mean, we've been conservative on China. We still think it's going to make 8% this year, but only just. I think it's going to mean that we're probably going to have to wait until July, probably August, September time before we see the economy begin to react to some of these moves. It's not just interest rates. We've seen the government authorize more investment projects. We've seen the Ministry of Finance increase its expenditure in the first quarter. So this is a coordinated policy of moves to gradually stimulate the economy. Nothing like in 2008 where they just threw the kitchen sink at the economy, but it still looks to us that they are embarking on a mini stimulus project.
Stephen, what would it take for the Chinese to want to throw the kitchen sink at the situation in the country right now? What would you need to see to expect far more aggressive moves on the part of the PBOC?
Right, I mean, externally, you need to see a big problem in Europe. If Greece exits, that might stimulate them to do more. Domestically, I think you need to see bigger unemployment problems. I mean, the amazing thing so far in China is that the jobs market is still pretty good. There's only a few stories of companies cutting jobs. In the main, the labour market still looks pretty healthy. But you'd expect maybe after a couple of months that's going to deteriorate a little bit, and that if it deteriorates too much, then they'll do more.
Is 8% growth in China considered a recession?
No, certainly not. I mean, it may be 10, 20 years ago, yes, but potential growth in China has come down. It's no longer a double-digit growth economy. 8% is probably about right. I mean, you've got to look at the labour market. The labour market's still pretty healthy. Wages generally still pushing up this year. So, 7-8% is probably pretty good for China. Somewhere around 5% for a quarter or two is probably more of a hard landing.
Stephen, talk about the timing of this rate cut. The European Central Bank didn't do anything yesterday. The Bank of England declined to do anything this morning as well. Investors certainly were not expecting it. To what extent did China tip off the other central banks?
Well, I mean, that's a great question. I mean, who knows if they're thinking about coordination or not. I mean, we've certainly seen over the last 3 weeks that the central government in Beijing has moved towards a proactive stance on growth. It's just that there wasn't much consensus that they'd move on interest rates so early. So I mean, it looks like they're seeing worse data for May, and I imagine it's the domestic scenario that's pushing them to do this rather than external things.
Now, inflation has been an issue that China's been trying to battle over the last few years. It's come down slightly. We're at 3.4% annual rate. Is that going to tie policymakers' hands going forward if it wants to lower rates to spur economic growth?
Not at all. No, inflation is not a problem anymore. This year, we're probably going to get 2.5% for the year. If you look at upstream inflation, like the inflation that companies face, it's basically zero. Imported inflation is negative now. So there's no real constraint on them from the inflation side. I mean, the one thing that PBOC, the central bank, doesn't like the idea of is kind of overstimulating the economy, throwing money at the economy, pushing up real estate prices, doing more investment. I mean, a lot of people worry about that you just repeat the old growth model and you wouldn't do sort of proper reforms. And that is a risk this year, that we sort of focus on the short term and don't look to the medium term when we really just need to do some more big structural reforms to the economy.
Stephen, to that point, there are some serious expectations built now into this Chinese rate move. U.S. equity index futures are trading quite a bit higher. What is it that the Chinese are going to be buying if the PBOC succeeds in stimulating domestic demand?
Well, I mean, it's a bunch of stuff now. I mean, you've got obviously the obvious things like iron ore, copper, oil, particularly. Oil is the biggest import. Soya from Latin America and the U.S. China's becoming a corn importer now as well. I mean, I guess the thing that's been really suffering is kind of on the manufacturing side. You're going to see, hopefully, if the economy does recover and private investment picks up a bit, you're going to see things like Germany, U.S., Japanese machine exporters, people like GE, Caterpillar, they're going to benefit. But at the moment, I think it's probably it's reversing the downturn, which is the focus, rather than really stimulating a big import boom.